Good afternoon, or possibly good morning, depending on where you are coming to us from. Thank you very much for attending today's webinar on how to assess multifamily real estate investments. I'm your host, Scott Maurer. I'm the Director of Business Development here for Advanta IRA. I've been with the company for a number of years now. Started out primarily helping people place their funds into different investments and actually processing the paperwork. And I'm excited to have today's guests on today because I can tell you when I first started back in 2006 and kind of in those, up to probably 2010, 2011, predominant investments that I handled and helped clients process was really in residential real estate. It wasn't really a lot of the multifamily and the syndications that we've really seen explode over the last 4 to 5 years. So really happy to have today's guests on. So again, as far as my background, I am a licensed attorney in the state of Florida. I do not do any legal work on behalf of Advanta, and my contact information is here on this slide. I'll have this up again at the end of the presentation if you need to reach out to me with any questions regarding self-directed IRAs. Just a quick disclaimer, Advanta IRA, we do not provide any investment advice or legal or tax advice. Now, in the context of a lot of our webinars, we do talk about legal and tax issues, and we will get into those at times. But when it comes to making a determination from a legal or tax perspective, we do encourage you to contact an attorney, contact a CPA, and we can certainly refer you to those individuals if you need a professional referral. And most importantly, we don't provide investment advice. We don't endorse any products or specific investments. So anyone who's looking to make an investment in your IRA, it is up to you to do your own due diligence, not only on the investments you're making, but on the people that you're investing with. Just a quick background on our company. If you're new and not familiar with Advanta IRA, we've been around for almost 20 years. And the only thing we do is the administration and handling of self-directed IRAs and retirement accounts. Currently, we have over $2 billion of assets under management, almost 9,000 active accounts. We really set ourselves apart with the concierge level service that we give to people. Any new account here at Advanta IRA gets assigned to one specific account manager, one point of contact. So anything you need regarding your account, whether it's making an investment, paying an expense, or just have a general question about your IRA account, you'll have that one point of contact with us. We also are big proponents of education and networking. So we do a lot of events. We usually do 1 to 2 webinars a week with different topics, different guest speakers, different areas of expertise to really try to help people grow their knowledge, not only just on self-directed IRAs, but on some of the different investment classes that we hold, and certainly maybe even on general tax law. We do host a networking event as well. We call it Pitch, Promote, and Prosper. That is just about every other Friday from noon to about 1 or 1:30 Eastern time, which does give everybody a chance to come in. If you're looking to find a deal, if you're looking to raise money for a deal, you can join those Pitch, Promote, and Prosper events and actually get out there and promote yourself. All of our webinars are recorded and they're available on our video library. So if you're listening live today and you want to go back and listen to something again that you hear today, you can certainly access that on our YouTube page. And if you miss a webinar or you want to see kind of other events we've had in the past, just visit our YouTube page and you'll see all the recordings there. For those of you who are new to self-directed IRAs or maybe haven't heard of self-directed IRAs, one of the questions we get even from clients once they establish is, hey, I wish I'd found out about this sooner, or why didn't I know about this sooner? And it's very simple. It's the fact that most IRA accounts, most retirement funds are administered by banks and brokerage firms who offer you only the products that they sell, whether it's a mutual fund, stocks, other publicly traded securities. But IRS regulations have a much broader range of allowable investments. In fact, the only 2 things you can't buy inside of an IRA account, you cannot buy life insurance and you cannot buy collectibles. There's also some restrictions on self-dealing and basically buying and selling assets from yourself and your account. But other than that, the IRS will allow you to invest in a lot of different types of real estate, private startup companies, precious metals. It's just up to each custodian to decide what they're willing to hold. And at Advanta, we will hold any number of all different alternative assets and leave the publicly traded assets to the banks and brokerage firms that are out there. As such, the predominant asset, I should say, that we hold at Advanta are real estate assets. Probably 75% of the assets we hold under our management are real estate in nature, whether it's a rental property, whether it's a fixer-upper rehab project, raw land, private loans and mortgages. And then obviously what today's topic is, we've seen, like I said, I mentioned, for the last 4 to 5 years, just a tremendous increase in the number of people investing in and using their IRAs to become limited partners and limited investors in multifamily properties and real estate syndications. And so again, we have a lot of education events, and it's certainly the one today focused on that because we've seen such a large uptick from our client base in these types of investments. And I think for anyone who is a real estate investor, or maybe even just an investor in general, it's really kind of figuring out what type of an investor are you that helps maybe guide you on the right path to which type of investment is maybe best suited for you in your portfolio. I think people who want to be more active and be more involved, generally speaking, tend to seek out rental properties, rehab projects, maybe do some real estate wholesaling where they're in control, they're making all the decisions. They're maybe a little bit more hands-on and definitely more involved. The downside, of course, of being an active investor is that you're responsible for all the details, and you're certainly going to spend more of your time and energy managing those types of investments. And on the flip side, we have many clients though who are passive investors, people who tend towards private placements and real estate syndications, like we're going to talk about today, where the time commitment, I think, for you to be an investor in these types of deals is really upfront, right? You're going to evaluate the deal, do your due diligence, and then after that, you're going to kind of sit back and let somebody else take care of all the details and the minutia of the investment. And so that's kind of what we're talking about today when it comes into multifamily real estate and syndications. And we have 3 guests with us today, the founding partners of JT Capital, Rohan, Pooja, and Sapan, all going to talk about really how to assess and evaluate multifamily deals. Because again, I think a lot of the people on the call, these types of investments are attractive to you, especially if you're somebody who fashions yourself as a more passive investor. But you need to know how to evaluate these deals when you see them, especially if you're someone who's looking to go from, say, buying single-family homes or rental properties, where you kind of already have the knowledge base to find the right investment, find the right, and do your due diligence on that. Moving into multifamily is definitely a different topic. So at this point, I want to bring on our 3 guests and allow them to introduce themselves.
Awesome. Thank you so much, Scott. Appreciate it and excited to be with everybody today. So on the next page, I'll kind of go over the agenda and then we'll go into introductions on the team. So we'll go through our team. We'll talk a little bit about, kind of what do we do, actually, me, Sapan, and Pooja every day, and then how you as a potential investor can kind of evaluate multifamily deals. So on the next couple slides, we'll each just give kind of our brief intro. I can kick it off and then Pooja and Sapan can go. So my name's Rohan. I handle primarily investor relations at JT Capital. Prior to JT Capital, I worked in tech at Facebook and then worked at GE in like finance and strategy roles with a little bit of real estate mixed in.
Hey, thanks, Rohan. Hi, I'm Pooja Talati, and I do the asset management for all of our properties at JT Capital. Prior to that, also had some real estate experience, and then from a corporate standpoint, worked at Deloitte Consulting for numerous years, doing strategy and operations there for a variety of industries and service areas, and then also worked in brand management at the Hershey Company.
Hey guys, I'm Sapan. I focus on the acquisitions and dispositions here at JT Capital. Prior to this, I was also in management consulting, predominantly focused on real estate, commercial real estate, on the strategies and operations side.
And so on the next 2 slides, what we'll talk a little bit about is kind of what do we do in just like plain English terms. I know that commercial real estate and real estate people can kind of get a little bit too technical with the details, and so we try to just break it down simply so people can understand what is it that we actually do. So when we show up to work every day, first what we're looking at is deals every day. Sapan, as you mentioned, leads our acquisitions and dispositions. He's analyzing numbers and financials, organizing property tours, constantly on the phone with real estate brokers, pretty much to find great apartment complexes. We're usually buying apartment complexes that are a minimum of 120 units or so, and then a maximum of 500 to 600 units. Now, when we find these apartment complexes that we want to go after, we move very quickly. We provide a fair offer to the seller, we negotiate any of the terms that we need to go through, and we strike a deal with them. And once we sign that contract, we typically have about 60 days to take over the property where we fully own that property. During those kind of 60 days, we will perform deeper due diligence on the property to make sure that we're not missing anything and our numbers are correct. So we, along with our property management team, will go into every single unit and kind of inspect the condition of each unit. We'll get backups of all of the financials, who are the vendors that they're using, what do those contracts look like. We'll check the structural components of the property. If everything checks out, then we're good to go and we continue to move forward. Before we even make offers, though, we tour the properties. We have a general sense of, what is the condition of the property. So usually things check out pretty fairly. Also within that 60-day timeline, we will raise money, the equity money from investors, which is usually anywhere from, let's say, 25 to 40% of the property value. So, on a $50 million acquisition, we may be raising anywhere from, on the low end, probably like $12 million up to about $20 million of equity. We put together a deck, a presentation, a webinar, we share that with our investors, and then they have the opportunity to ask us any questions and then invest in the deal if they would like to. The remaining part of the funds that we get for the purchase of the property is through debt. And so we have loan broker relationship in place where we're pretty much able to source attractive financing. I would say in 2020, we were getting interest rates that were, below 3%. In 2021, they were about low 3%. And now in 2022, they continue to be in the low 3% range. After that 60 days is over, we ultimately close on the deal, we get the keys, and now we begin running that property and managing it on a day-to-day basis. What we do is we provide distributions to our investors in the form of direct deposits to their account because people are paying rent. We are, managing the property, paying expenses, and then the cash flow primarily goes to the investors. We provide monthly updates on how things are going with the property and keeping people up to date. A core part of our business plan is really focused on what we call value add or core plus deals. Really what we do is focus on three components. One, we go in and we do interior unit renovations. So we upgrade the countertops to granite countertops. We install stainless steel appliances. We replace plumbing and lighting fixtures to make the inside of the apartments nice. Two, we fix up any deferred maintenance. So this might be things like restriping the parking lot. It may mean upgrading the amenities in the gym or the pool or renovating the clubhouse. And then lastly, what we do is we have a competitive advantage that we have a partnership with a company called Bell Partners, which is one of the largest property management companies in the nation. They've been around for 45 years and they have about 70,000 units under management. And there's a top tier type of management firm. From a property management perspective, they manage and they have the on-site employees on our property. And then as Pooja mentioned, she's the asset manager who oversees all of those teams. As we're doing and executing that business plan, we're gradually raising rents on the property. That ultimately increases the net operating income of the property, which increases the cash flow of the property, and the investors can continue to reap those rewards of increased rent and increased cash flow. Usually after some period of time, 5 years or so is usually what we're holding these for. We go to sell the property at an increased price. We're able to sell at a higher price because we've increased the value of the property by executing our business plan and being able to raise the income that the property is generating. After we sell, the investors partake in a large gain from the sale of that property. And then we just go on and we continue to find the next deal. And then ideally our investors love to, continue to reinvest with us, which happens in most cases. So that's a little bit of what I would call like the general framework of what we do on a daily basis.
Yeah, Rohan, this is Scott. I had a quick question for you. Just I want to encourage anyone who's listening live, you have a question box on your screen. You can type any question you have for any of the panelists or myself today. I will make sure we get to that. Just in the multifamily space, is a 60-day time frame is kind of, I guess, maybe from initial contract to closing. Is that fairly typical, or are there things that can make it shorter or longer? I mean, I just wanted just curious what the that 60-day time frame, again, is that pretty standard in multifamily?
Yeah, totally. That's kind of like the fairly typical term, 60 days. You know, there's always edge cases. So for example, towards the end of last year, in December, we closed a deal that was 336 units that we purchased for $85 million. That one, I believe we may have closed it in about 45 or 50 days or so. The reason for that was that the seller, you know, had a little more constrained timeline because they were doing a 1031 exchange, which meant they were going to take the sale of this property and they had already identified another property that they were going to go invest those proceeds into. And because of that, they needed to close within this 45 to 50 day timeline. So, you know, that's one of our competitive advantages, is that we're able to move quickly. We don't have to deal with, you know, lots of bureaucracy and things like that. So 60 days is typically, you know, the general timeline, but there's times when it is, can be shorter based on unique circumstances.
Okay, thanks for answering. We have actually had a couple questions just pop in. I'll ask a couple of them, and I'm going to leave some of the other ones for later as well. Someone just asked, so how, because you all were talking about obviously your experience, how long you've been around. Someone want to know how long have you been in business at JT Capital?
Yeah, totally. So all of us, myself, Pooja, and Suppan, have now been doing this for like close to a decade in real estate. Before we started JT Capital, we were just joint venture partners. So me, Suppan, and Pooja were doing deals together. However, we had separate companies and we were just doing partnerships. And then a couple years ago, we decided, hey, instead of doing these joint ventures, we like working with each other. We have shared values and interests. Why don't we build this under one umbrella? And then we all started JT Capital together. So it feels like, you know, we've been in business for quite some time.
Okay, and similar in that same kind of vein, someone asked how many properties, I guess, and I guess this could include ones you joint ventured as well, have you kind of purchased and then repositioned or you know, I guess sold during your time?
Yeah, in total, for each of the partners, our total track record is close to about a little over 20 assets now, with a transaction volume of $500 to $600 million.
Okay, great. Thanks for answering those questions. Like I said, there's a couple more. I'm going to leave. I can see them coming in. I think we can get to some of those later. I want to make sure I get back to the presentation. We don't lose track of that. So, do you want me to go ahead and I'll go ahead and go to the next slide?
Yes.
All right. So, yep. All right. Go ahead.
Yeah. So, you know, when you're looking at, you know, a real estate investment, specifically with multifamily, because that's what we're going to talk about, you know, as an investor, there's 3 questions that we think you should really think about when you see a deal that is being offered to you. So one, is this the right market for me? So think about, you know, do you want to, I'm from Austin, so do you want to invest in a city like Austin, or do you want to invest in a tertiary city, so, you know, a suburb close to Austin, right? You're going to see different returns depending on the type of market. And that also really just kind of goes to like, what are you looking to gain out of the investment? Number 2, can this deal generate good returns? So how is it structured? Is that something that works for me and what I want as an investor? And then number 3, can the sponsors execute the business plan? So, you know, what is their experience? What is their background? Does this sound like a sound business plan? And Suppan and I will talk a little bit about these 3 points in more detail.
Is this market right for me? So really, it's just balancing safety versus risk. And so what do we mean by that? Are you comfortable with, like, we'll talk about risk for example, and risk could be anything from number of jobs and employment to the demographics, to just the vicinity to near schools, or just areas that have been prone for natural disasters, versus safety. This could be the age, so we call it vintage of the asset. Is it a new build, new construction? Is it 1990s? Is it 1960s or 70s? You know, the older the asset, there's inherent deferred maintenance. Also, it could be outside of the city, so maybe what we call tertiary markets. They tend to have slightly different economics than if you were, say, in an urban infill area, which is more like a city. And then again, talking about cities, there's different types. So am I in, a city that's had recent or evidence of, forward-looking growth versus something that might be more flat in terms of appreciation. However, it's had, good rent or cash on cash return. So there's different types of risks and different safety metrics. So really it's like what type of market, and that's where we're going to move into, linear versus cyclical versus hybrid, do I want to be in? So when we think of certain cyclical markets, we think of ones that are really riding similar to, maybe like Wall Street, where you're going to have a real big boom on a bull cycle. You'll get hit by the recession a little bit more. It's not as stable, but there's a lot of money to be made. Versus a linear where it's more consistent. You're not going to get the high pop on a return, but it's going to be a bit more consistent. You make a lot less on the appreciation. However, you do enjoy the cash on cash returns on a more consistent basis. And so it's just what type of market do I feel comfortable in? Kind of going back to the safety versus risk. And then from there, you identify which markets that you want to be in. And so from there, it's some of the things I'd mentioned, looking at patterns, so growth patterns, migration patterns. And, I'll just use where we looked for as an example. I'm going to use Central Florida, particularly like Orlando, out east towards the coast, towards Melbourne. We really follow, for us, it's important on the employment side of it. And then within that, we look for specific types of jobs or job sectors that we feel are going to continue to sustain itself even through a recession, or there's going to be strong enough demand. And then that's coupled with housing patterns. So we'll look at new home starts. We look at pricing of these new homes. And then same thing with apartments. We look for, are there new Class A apartments going to be built or scheduled to be built, and how will that impact our rent? We look at the rent comps in that market to see, kind of what the rents are versus the subject asset. Within that, we'll look at, is this well below market? Can we bring it up to market value in terms of the rent? And then what will that cost us? So how much are we going to invest into what we call CapEx into this asset just to get the asset to market value? And then from there, forward looking, do we see evidence of rent growth, or is it going to be flat, or do we see declining rent in that area? And we'll price all that into what's our overall ROI on the asset on a project level. And so we follow everything on a project level. Some other things we'll look at is the cap rates. I know we've seen a lot of compression on the caps, especially in all over the country, but notably like Austin, for example, it's another market we're invested in. But these cap rates are so low that we feel the only way where the cap rates will go is they're going to increase or expand, which inherently will lower asset pricing. So that's even more important. Can we get the rent growth? Can we maintain occupancy? And a lot of that's driven by employment versus being in certain markets where it's predominantly residential. Maybe the strength of the employment's not there, and that for us causes some risk. And then of course we'll get into the debt, later on in the presentation.
Okay, so can the deal generate good returns? So Stephen talked a lot about market fit, and I'll go into it from like an asset management standpoint. So what's the opportunity that your sponsor is presenting to you, right? So you really need to understand their business model and strategy. So for example, what we typically do is we'll look at a B or B plus asset. And typically what we do is we'll add value to the property. And so we'll renovate the apartments and then increase that value and sell it later on. But that model also really only works if you understand your market. So for example, are there a lot of A-class units around you or other B or B plus assets that have already been renovated? For example, do they have like vinyl plank flooring? Do they have stainless steel appliances? A nice, instead of white walls, do they have gray walls or, a different paint color? Do they have granite or quartz? And if the property does not have a lot of those things or doesn't have a lot of these amenities, well, then okay, this value add plan really works. And then you can take a look at what the surrounding rents are in that area. And then say, okay, well, if these renovations are completed and they're saying that we can increase the rent by $200 or $300, and then you can kind of look and say, okay, well, it's nowhere near the A class, even if you increase the rent by $200 or $300, and that's fine, but it shows that you have room to do that. So essentially, they should be showing you what are the comps in the area, what are they doing, what's the competition. Another thing to also look at is occupancy within the area. So if it has a generally higher occupancy, that's a good sign. It tells you that there's a demand for people wanting to rent in that particular area. The next question is, what are the acquisition factors, right? So you kind of want to ask those questions, but well, why is the property being sold? Is it a distressed property, or did they run through their cycle where they're planning on holding it for 2, 3, 5 years, and now it's the right time for them to put it on the market? So understanding that will also help you understand, what is the new operator's intention and what are they planning on doing with the property. You also want to look at the cap rate, the NOI, and just understand if you did the back of the envelope math, okay, does that fit with that particular area, or do you think that the offer price was too high or too low? So just some of those things to kind of think about as they're buying the property. When you think about it, what's the opportunity on the property? That's where I ask the question if it's a value add, or are they just looking to hold it, increase the rent as the market allows, and then if it's an area that's just appreciating a lot, maybe that's their strategy. Some people do buy and hold for long term. Some people do three-year hold, 5-year hold, or 10-year hold, and that's partly for you as an investor to kind of think about what type of deal do you want to be in, and what are you comfortable with. So think about that, and then when they're talking about the opportunity with value add, some of the things you want to ask is in your mind, well, what is their experience with doing these types of renovations? Do they have a construction team in place? What's the plan? Are they going to do this within 1 year or 2 years and turn all of that around? So those are just questions to ask. If they usually give an offering deck, and most of that's laid out, but if it's not, then you would want to make sure that you get answers to those questions. And a lot of that will be in the pro forma and the assumptions, and just look through them. Most operators should, if you ask certain questions of like, oh, why is a marketing budget of like $80,000? They won't have it broken down line by line item, but they should be able to really tell you where those $80,000 on an annual basis will be spent, or what are the utility costs, or what are the taxes? An experienced operator would easily be able to put that in the pro forma and be able to tell you exactly like why it's broken out a certain way. The debt structure, so that's really important. You want to make sure in the pro forma that the refinance is not included in the projected returns. That just actually inflates the projected returns, and if the refinance doesn't happen, well, then the numbers for the projections are off. So you want to make sure that when you're looking at a deal, that the refinance is not included in that. And then you want to question, the projected returns and the analysis and the LP return structure. So does that work for you? What are the fees involved? And then how is the structure? So some people will do, let's say like a 10% return and no split, or there's a specific like 7, 8, or 9% return, and that just depends on how much you invest. And then there's a hurdle to meet, and then there's a split. So there's many ways to structure a deal. Just make sure that you understand what the structure looks like and what it means for you, because each operator does it slightly different.
Hey, Pooja, or I don't know if this is maybe a question for Sapin too, but one of the questions somebody had came out and said, what is a good resource for LPs? Like, we're going back to kind of like finding out if a market is right. Obviously, you're talking to a multifamily operator who they've determined that market is right. Is there a resource for LPs, someone who's looking to invest, to find out that that market is indeed a good one?
So I'll answer part of it, and then chime in from your side.
Sure, go ahead.
In the offering memorandum, there is a section for the market analysis, right? And usually it's backed by, some well-known companies like Yardi, for example, RealPage, right? They have the statistics, and usually that should be in there. So you should be able to see, like, what's the growth rate? How many people are coming into that area? What's the supply and demand looking like? So if demand is outpacing supply in that particular area, that's good. You want to look at the average income, and all of those things typically should be in the offering memorandum, and then just make sure that there's a source behind it. And Stephen, I don't know if you have any other places that limited partners look at as well.
Sure. So, I mean, outside the OM, I mean, and that really is a good place to start if you're looking actively at a project. I'm probably just going to put my underwriting hat on for a minute and give you maybe a different perspective of how I would look at it. And this is really just my comfort level. But if I'm looking at investing in a deal, oftentimes I'm not going to invest in a deal unless I'm familiar with the market. So I might have already come up with a list of markets that I may want to invest in. And then I'll go out and find operators or investment opportunities within those specific markets. And then, of course, you know, their research data that will be in the OM will kind of further my understanding. But yeah, there's absolutely nothing wrong with, you know, finding listings and looking at maybe the broker OMs. You know, there's a lot of data out there, you know, through different websites where they'll, you know, you can find top performing maybe commercial apartment markets for a variety of reasons. And then from there, you know, you kind of just peel back the onion and kind of get an understanding of, you know, what's the employment data look like, where have we seen growth, you know, during the COVID period, where have we seen, you know, certain markets that have performed well through COVID and what's expected to perform well post-COVID. You know, where are the migration patterns, you know, so simple things like, you know, I was reading about, now it's probably about 19, 20 months ago, there are a number of folks who were, you know, moving their businesses or relocating them to North Jacksonville, you know, migrating out of New York City, very specific to North Jacksonville. And so that would be an area that I might look into as to, you know, could be talking to some brokers over there. At least in my case, you know, for LPs, it could be just looking for data as to, you know, is there significant movement, you know, therefore is there a shortage of single family homes, you know, has occupancy increased, and this is all publicly available, you know, so from there inherently you'll notice that, you know, rents should therefore increase just due to supply and demand, but is it sustainable? Sustainable meaning, are we just seeing an artificial pop in rents? But if we're seeing job growth, that's more likely a leading indicator towards we're going to have, you know, that type of demand is going to be there, you know, and unless we're seeing new Class A, which I don't expect LPs to look for, but unless we're just seeing that, you know, we can't expect the supply levels to increase. But a lot of that, again, is also available. There's websites out there like Globe Street, you know, they give a lot of good commercial information. You know, there's some other ones out there as well, but that's one that I particularly like. You can always go to CoStar. They have a lot of data information. You don't need a subscription there. And like Pooja mentioned, Yardi as well. And again, you don't need subscriptions to just read like current events on these unless you're looking at doing analysis on a detailed level.
Yep, and it kind of had another question pop up too, kind of just go to it. I don't know if this you talk about this later or not, but someone just was curious, kind of maybe what the average return of investment is, the ROI is on the deals that you do. Happy to, you know, if that's something you're gonna talk about later, we can push it off. But that was a question that came up just kind of from your own track record.
Yeah, it always depends and always changes based on each investment. Usually we're targeting somewhere in the range of like 100% ROI over 5 years. So that comes out to an annualized return of about 20% per year, or 20% IRR. You know, half of that is around usually factored in the cash flows that people are getting during the hold period. And then the rest of it is based on the sale of the property. But each property is different. Whenever we present an opportunity to investors, we put in our presentation, what do we expect this one will do? As an example, like some are outlier returns. We bought a property in Austin in 2020 for $35 million almost. And we raised $17 million of equity. We're gonna probably sell that one in the next couple months for almost $60 million. So, you know, and that'll be a much larger ROI. So, you know, each one just kind of depends.
Okay, thanks. Yeah, again, hopefully people keep the questions coming. I'll let you get back. When we move on to the next slide? There we go. Yeah, I wasn't sure who's. Yeah, I'm sorry. Go ahead, Rohan.
So yeah, this one is really just about like can sponsors execute the plan? So as we mentioned, you have to do your due diligence, evaluating markets, kind of looking at financials and things like that. But you know, ultimately, a lot of this business just comes down to the general partner, or also known as the sponsor, which is really the person or people that are going to be running the deal on a day-to-day basis, because they're really trusting their judgment. They're the ones who are evaluating deals every day. They're the ones who understand, you know, markets and sub-markets, and so you're really putting most of your trust in them. I think this is mostly a people business. Anyone can make any model or estimate look however they want it to look, really, at the end of the day. Investors can ask questions and get a sense of it, but you're really relying on the people. And so when you're doing due diligence on sponsors, you really want to understand a variety of these things. One, what is their kind of track record? You know, I'll be the first to always say, like, historical returns are no indication of what future returns will be. But again, that gives you a good baseline of what have these people accomplished, whether it's in real estate or even outside of real estate. Two, what is their experience? So again, like, have they done acquisitions in this particular market that they're bringing you an opportunity for? Do they have some type of specific experience that helps validate them as the right person? Do they have a great team, right? Like, the GP is one thing, but you know, there's many teams that they're using, most notably the property management team and others. But you know, is that property management team the right one that's in place? Because so much of an execution of a business plan really hinges on the day-to-day work that gets completed. And the last couple things are just like, what knowledge, resources do they use? What do they have? What are they reading every day to kind of get an understanding and stay ahead of the curve? And then lastly, do you just have that inherent sense of trust with them? When you talk to them every time, it's kind of like another touch point where you're beginning to evaluate, okay, is this a person or group of people that I can trust? So, you know, you want to really do your due diligence on sponsors, because that's ultimately what's going to kind of make these deals successful. And on the next slide, we'll kind of go into.
I was going to say, Rohan, if you can, I have a couple questions I think popped up. I think that would be good to ask here. Maybe you don't have to get too specific on it, but one of the question was kind of what annual remuneration do I guess you guys take, and maybe you could answer that in general too if you don't want to get specifics, because it might be deal to deal. But is there an average kind of you know, GP's percentage or GP's you know, take from a particular deal? And then the follow-up question to that too is, you know, do you or do typically the sponsors invest in their own deals as well?
Yeah, totally. Yeah, all really good questions. So I'll just walk through our overall fee structure and then kind of what happens on an annual basis. So the way our fee structure works is at the time of closing a deal, we take a 2% acquisition fee, which is pretty standard in line with the market. During the time we're holding the asset, we take a 2% management fee based on the income of the property, but only when we're hitting the investor pro forma. So we need to hit the investor projections before we can take any fees from the cash flow of the property, because if we're not hitting the investor projections, then, you know, what are we doing? And then from there, we have a 1% disposition fee when we go sell the asset. Typically, the way we structure it for investors on deals is we're providing a 7 or 8% preferred rate of return, meaning the investor receives 7 or 8% on their money before we participate in any of the cash flows of the property. So that's kind of typically how we structure our deals.
Okay, thanks. So I'll bump the slides here. We can get on. I guess you want to talk maybe about cap rates and how to calculate that.
Yeah, so the quick way to calculate the cap rate, it's right there. So cap rate is equal to the annual NOI divided by the sales price. This formula is really important. Sepin and Rohan use it a lot when they're kind of doing the litmus test to even see, like, okay, is this a property kind of worth looking at? It is basically the price you're going to pay for the property, and that's how you kind of figure that out. It's your unlevered return if you're paying 100% cash. And it's a way for you to also compare different properties within that market. And I'll go into a little bit more detail of why this matters on the next slide. So Yeah. So from an asset management standpoint, this is really important, right? So here, for example, below you have a 1 million NOI divided by a 4% cap rate. It's $25 million sales price, right? If you increase your NOI by $500,000, and then you divide that by the same cap rate at 4%, you can see that the purchase price just increased significantly to $37.5 million. So this is partly why when you're looking at a sponsor's plan or business plan and what they want to do, it's important to see how, where's the purchase price, what are they planning on doing, and then what are they projecting, the sales price or the return to be. So from an asset management standpoint, if we're doing value add, for example, it's really important to say, okay, maybe it takes $8,000 to $10,000 to renovate an apartment, and you're only getting a $200 or $300 rent bump. You might say, okay, well, that doesn't really sound like a lot. Well, it is, right? Because it adds up. It's $300 per month per unit, and you times that by the number of units that you renovate times 12, and all of those dollars add up, right? So it's really important to make sure that you have, lean expenses, trim your expenses as much as possible to increase your NOI, as well as just, increasing the rent. And by doing those things, every like $10,000 that you increase the NOI, you are potentially increasing your future sales price by that much more, right? So it's not like a one-to-one, you increase your NOI by 10,000, that means your value goes up by 10,000. It's actually very different from when you're purchasing a house, which is more on like the appreciation, and yeah, you do a few things and that helps the value, but really with multifamily, the first thing, people always look at is your cap rate, and what's the NOI, what's the room on the table for, if I'm a buyer, to increase that value purchase price even more. And then Stephan, I think it might be good if you want to talk about like the low cap rates in the markets, and some people have a hesitation with that, and how you bake that into, the modeling side of things, and why we shouldn't necessarily shy away from buying a property because it's a low cap rate.
Yeah, we look at cap rates, but it's not an end all be all. I know a lot of LPs may focus on just the cap rate, almost singularly. There's other variables that come into play. At the same time, we don't want to buy something that's just a really low cap rate, but we do want to understand why it's a low cap. So sometimes it could be because the income generated on the asset is not anywhere close to where it should be. And so, for example, just a rudimentary, and I wouldn't use this necessarily as a metric, but you have a good idea of what the expense ratio is for a decently performing to a well-performing asset in a given market. And let's just say arbitrarily that's 52% or whatnot. But you're looking at an asset, and that expense ratio could be closer to 70, 75. Just off of that, your first question is, are the operating expenses really high, or is there just not enough rental revenue? And then why? Why do both sides of that? And so it may arbitrarily have a very low cap. Sure, you're giving up a little bit of premium, but then using the example we just provided, if we're able to increase or decrease, right, the expenses, or increase the revenue there, and just kind of even get that more in line, does the premium, is it significantly lower than what I'm going to be creating in terms of the value here? And then it goes back to the market. So we're doing this in markets where we don't feel there's as much, I would say, uncontrollable risks, because we're very familiar with the market. And so the risk there is just your normal market risk. And then the bigger risk is really just, can we perform? And that's where we're comfortable, because we've done this many times over, and we go in there with a business plan that, not only are we aligned with, but also our property management company is in alignment with. And then we talk to our lender extensively as well with our business plan. So they're on board with it, not so much of, we're just seeking debt for X amount and we want to get the lowest interest rate, but rather we do include them in a very detailed level of what our business plan is on that. And then we'll actually create debt products specifically for that. So it's not just focused on, as saying low interest rates and the highest dollar, but really what's the best debt product specifically for that asset. And then just so talking about cap rates here, we do expect them to increase at every deal we look at. When we're going into it, look at what's that cap rate as we're going into it relative to the market, and then what's it look like on the exit with a much higher cap rate. than what we're buying it at, and that's how we model it. So we're never modeling anything at a lower cap rate. Obviously that would increase value. We don't want to artificially increase value on our models. We actually want to see the value increase because it's revenue driven, but also in a worst case scenario, which we're actually expecting, cap rates to increase.
The second financial metric to look at is called cash on cash return. So, cap rate is one thing that we're looking at as it relates to understanding what is the value that we're getting as we buy the property, right? And as Sampath alluded to, like it's one of a few different metrics to look at. Cash on cash will show you what is the forward-looking cash flow return that I should expect on this investment. And so, when we talk about NOI, as Pooja referred to, the calculation is the revenue that I generate minus my property expenses equals my net operating income. But we have debt that we place on the property, right? And so I need to make a mortgage payment every month. So I take my NOI and then I subtract my mortgage payment. And then that is finally the cash flow that is left over to be distributed to investors. And so we take that cash flow and we divide it by what is the initial investment that I put in as an investor into the property, and that equals my cash on cash return. And that's something you really want to look at because that's showing you kind of like what is your true return. So in this example, let's say we buy a property for $35 million. We raised let's say $10.5 million, which is a little low. Like usually would be raising a little bit more than that, maybe like 12 to 13 million bucks, but for purposes of this example, it keeps it simple. The mortgage is $24.5 million. Let's say the revenue on that property is $2.8 million. The expenses, the property expenses are $1.4 million. So I have an NOI of $1.4 million. My mortgage payment is, again, we're just trying to keep things simple here. Mortgage payment is 400 grand, and then my cash flow is $1 million. So if I was calculating my cap rate, I would take the 1.4 million in NOI divided by the $35 million purchase price and say I'm buying this at a 4% cap rate. However, if I look at the cash flow of that property divided by the equity, right, the actual money I had to put up, my cash on cash return is 10%. And so that's one of the beauties of being able to use leverage. While you need to be careful using leverage, that's one of the beauties because it's able to kind of like increase your return because you don't need to buy things for 100% cash. You can buy it for a lower amount because you place debt. And I realized I forgot to answer the question before about how much we co-invest into each deal. And so this is probably a good part for me to kind of discuss that. Typically on any given deal as a GP, we're looking to co-invest around 10%. It'll change on every deal. Sometimes we've done as little as 5%. Other times it's been as high as like 17 to 20%. So it really just depends on each deal and kind of like, investor demand and stuff like that. But usually we're targeting around 10%. So in this example, if we're raising $10.5 million of equity, we would target on average trying to invest $1.5 million as a co-invest. So LPs can say, okay, these GPs have some financial skin in the game as well. But more importantly than that, for us, we think that, the most important skin in the game is our reputation. We're building this company for decades and decades. We want, our investors' kids to invest with our kids in the future. And so because of that, we always need to make kind of these longer term decisions. So on the next set of slides, Sampath will talk through, the last metric, which is IRR, before we kind of wrap it up.
Sure. So IRR is just a common metric that a lot of investors use, probably because it's difficult in real estate to evaluate one deal to another, right? To do a true apples to apples comparison. IRR is probably about as close as most LPs can get. And so the IRR is basically just projecting the annual growth of the particular investment over a period of time. And so what's that IRR look like over a 5-year period? So that's, again, going back to a projected return. And at the same time, we can say, what was the IRR that, was actually realized over a period of time for a particular investment. And that way you can compare different projects. we look at that as one metric. There's certain things that IRR doesn't measure. For example, it doesn't take into account the project risk. Some projects inherently have more risk than others, and the IRR won't take that into account. It won't take into account maybe your discount rate to you as an individual investor. And so, for example, you may have a discount rate of 10%, an NPV, and it's not going to take that into account. However, it will allow you to compare project to project, on an annualized return. And then some other things like the deal size itself won't be taken into account, in the IRR metrics. So there's some shortfalls of IRR, and that's where we believe focusing on cash on cash, the equity multiple, annualized return will kind of give you a better gauge for what type of return you're expecting or you would like to see for yourself relative to other opportunities and projects that you might be looking at in other industries. And if it is multifamily from apartment to apartment, you kind of want to make sure it's similar like to like market to market, class A to class A. You can look at the IRRs, compare those as well.
So to kind of sum up, a lot of what we're saying is what we do is we always have a checklist, and we believe LPs can kind of think about the checklist in the same way, in addition to the things we said, which is for markets, is this market growing? Do I believe it's resilient? Especially in times right now where, there's likely a chance of a potential recession coming on. I'm focused, and we are focused more on resilient assets. 2, do I actually love this property, and does it fit our or my requirements, right? Is it, strong construction? How old is it? These kinds of things. This location, do I love this exact location? You can pin a market, a sub-market, a city, a zip code, but this particular street, this location, is this an attractive location? Financials, do the numbers make sense? Is there kind of a margin of safety? And every deal we do, it'll depend on each deal, but we're always setting aside reserves of anywhere from like 12 months to 24 months of mortgage payments that are specifically earmarked for mortgage payments. So in the event that we have some type of disaster scenario and everybody leaves Orlando, we can still cover our mortgage for a significant period of time, and that allows us to sleep at night and protect investor capital because we know we have this large margin of safety. And then lastly, what's the competitive advantage? Like, what unique advantages do we have owning this property? Do we have a property in the area so we know this market really well, or we have access to certain data that other people don't that allow us to see the asset differently? So this is kind of our 5-step checklist and our basic process. I think LPs can kind of mirror this in addition to going through the things we talked about before. But for us, what we always guide LPs is being able to trust the sponsor, know the sponsor is like the single most important thing. And then these checklists are kind of what we use internally. And so, it's been great talking with you all. I think we'll do some questions and happy to answer those. But yeah, if you're interested in, even just learning a little bit more about what it is that we do, allowing us to go deeper, I'm happy to have a 30-minute conversation with any of you. You can just go to our website, which is jtcapitalgroup.com. You should see a button which says Invest Now. You can click that, and that will link you to be able to schedule a time to speak with us. Or if it's easier for you, you can just email admin@jtcapitalgroup.com, and we'd be happy to set up a time and talk with you a little bit more. So thanks so much for having us, and happy to take any questions.
Yep, thank you all. That was great information. We did have a number of questions. Like I said, I thought it'd be good to keep a bunch here at the end that all kind of in that same vein. So just going to some of the questions, I guess someone had a question on, obviously the disposition of the property. Eventually, if you buy a value add property, you fix up the units, and eventually you want to sell. Is there a particular time period? I know you mentioned a 5-year time period at one point. What is it? I guess what is the time period once how does that work when you're looking to sell? How long do you want to hold a property for before you actually sell it?
Yeah, each asset will be different. I would say typically what we're doing is 5-year holds. So we'll go and we'll explain to investors before we purchase the property and close on it, and we'll say, hey, here's the deal. here's all the financials. We estimate that we'll hold this for 5 years. And then we'll get into executing our business plan once we take it over. Usually takes us like, let's say 1 to 2 years to do all of our renovations, increase rents and all of that kind of stuff. And we'll sometimes pursue refinancing the property. So we could say, hey, we can actually return a significant amount of capital back to investors because the property is now valued at this much higher. And so we can just refinance it, place debt on it, and then investors can keep getting cash flow. Other times we'll say, hey, we've run and executed our business plan. We're at the 3-year mark maybe. We believe we've achieved the highest value we can out of this asset. Now we believe it's the best time to sell. So it really depends on each different asset. Like I mentioned earlier, we have one in Austin that we're going to sell below 2 years because we believe we've hit the highest value that we can on that one. For maybe another one in Florida coming up this year, we'll likely maybe refinance that one and hold that for a longer term because we still believe there's a lot more runway there. We'll always look at the market and kind of what prices people are paying and everything like that. So on average, I would say about 3 to 5 years we're selling them after, but some will hold much longer term. Some might be a little bit less, but we always set those expectations with investors before we buy the property so they know what they're investing into.
Gotcha. Here's a quick question. Somebody asked, how many units do you currently own today?
Maybe close to 2,000. Supin, is it somewhere in that range?
No, it's actually closer to 3,000 today.
Okay.
Another question someone asked, what's the promote or waterfall structure in your deals that you typically have?
Yeah, each deal will be different, but typically it goes something like this. We pay a 7 or 8% preferred rate of return to investors. There's usually a 70-30 split, 70 to LPs, 30 to GPs, and then we will do some type of predefined waterfall at a predefined teens IRR amount. So usually 50-50 at some teens IRR amount. It'll always change based on the return that we're targeting for investors. Generally speaking, we've been targeting anywhere in the range of, let's say, like, on the very, very low end, 14% IRR. On the more common end, somewhere in the range of like 17 to 20% IRR. So those are the ones that we'll always, 70 to 20 is usually what we'll try to hit for investors. For any reason we are, going to fall short of that, what we'll do is we'll just sacrifice our own promote to make sure that investors can be hitting the returns that we set the expectations with them at the beginning of the project.
A couple of people asked, do you all have a minimum investment amount is that project specific, or is that kind of just general guideline that you have for all your investments?
Yeah, again, project specific. Usually the minimum, especially for kind of like people that are investing with us for the first time, we'll tell them to come in around 50K. So some of our investors, if they're first time, they'll start at that amount. Others will do, more generally kind of like 6 figures. And then we have a few anchor investors that do kind of 7-figure checks.
Okay, I had maybe combine 2 of these questions into one. Someone asked maybe to describe the worst deal you've ever had, which might be kind of fun or not fun. But the other question I think that ties into that, maybe talk more broadly too. Someone asked, what's the typical risk with this type of an investment in a recession? Like, where does the risk come in from the investor's perspective?
Yeah, sure. So I'll take both of them, and then Supin, if you want to add a little bit more color on the second one around risk, or Pooja, that'd be helpful too. So yeah, in terms of worst deal we've ever done, I would say we bought a deal in a good market, in a good sub-market, but the location that we bought it in, we believe the path of progress was going to continue. So we thought that the more real estate investors were going to come in, they were going to build nicer retail and all these different types of property. We thought that the city was going to continue to invest kind of in that path of progress, and it just didn't happen. And so our assumptions on kind of making the location better were not there. And so because of that, we weren't able to push rents as much as we thought we would. And it ended up being, it was still like a double-digit IRR, but it was a low double-digit IRR, which, for us in the business we're in, that's not what we're targeting. In terms of and so that's why in our checklist we talk about location. because location is so important. You can buy a property, you can make the property nicer, but you can't make the location nicer. And so that's really why we focus after that experience on just really high quality locations. In terms of risk, I think in real estate, the biggest risk is being a forced seller. So we saw in 2008 what happened is people were over leveraged, they couldn't make their mortgage payments, and therefore they had to liquidate their investments, right? In real estate, that's pretty much the only way, generally speaking, that you can lose money is being a forced seller. In the markets that we invest in, there's these high populations, diversity of jobs, no state income tax, business and landlord friendly climates, which is, Central Florida that we're investing in, and then here in Austin, Texas. And so because of that, like, you don't really deal with a lot of like population risk where maybe you're investing in Odessa, Texas, and there's one person, it's the oil and gas employer, and if they go out of business, the whole town is leaving, right? But in like Central Florida, it's not the case. And so that removes that risk off the table. Then you have execution risk. Can we execute on our business plan? Things like that. But these properties are already cash flowing, so you'd have to screw it up really, really badly. The lender would, step in well before you screwed it up that badly. And so ultimately what it comes down to is being too over leveraged. And so, as I mentioned earlier, what we do to kind of have that margin of safety is we'll take on a good amount of leverage, in some cases maybe 65% leverage, in other cases maybe 75 to 78% all in leverage. But we are buying properties that are already at 90% plus occupancy. We're just doing value add work. Our renovations maybe take 1 to 2 weeks. We're increasing rents. We're keeping occupancy stabilized. And then ultimately, we always have that cash in the bank that we've earmarked for mortgage payment reserves. So if anything ever happened, like these worst case scenarios, black swan events, we still have money in the bank to ride through these events. So in a recession, the way that we're preparing for it right now is, hey, maybe we won't have as much rental growth, but that's okay. The property will still cash flow. We'll ride it out. And, once the economy begins to grow again, then we can take advantage of that.
Okay, I had maybe a couple questions here. We'll try to wrap it up too. And so if I don't, apologize if I don't get to your question, someone who's watching and you asked it, certainly reach out to Rohan, Pooja, or Sapin, and they can answer your question. But I guess maybe from an investor standpoint, a couple different investor questions. We'll tie these up and then we'll wrap up. One of them is, what are investors required to report to the IRS each year? Assuming each investor gets a K-1 from you all. But and tying into that, are you using cost segregation and bonus depreciation in your deals?
Yeah. So I'll answer that. Yeah, so typically, yes, we always do cost segregation, which includes the bonus depreciation. We'll do that pretty much as soon as we close the deal. And then from there, you will get a K-1. Typically, the first year, you'll always see like the most negative K-1 because that's where the bonus depreciation falls in. And then you'll typically see a negative K-1 that's not as high as the first year, but you'll see that throughout the process. And so on every deal, you'll get a K-1. You just give that to your CPA, and then you file your taxes. So that's really all you'll need from the investment standpoint.
Okay, and like the last question, I said if I don't get to your question, I apologize. You can reach out to these folks to get your answer. But last question, someone asked, do you work with accredited and sophisticated investors? I didn't know kind of what what people maybe cover that quickly, what that means to be accredited or sophisticated, and what you do work with.
Yeah, absolutely. So accredited definition is if you're single, I believe you've made what is it, $200,000 each of the prior 2 years, and you have the expectation that you'll make that much this upcoming year, or you have $1 million net worth, not including the value of your home. And then if you're married, the same type of framework, but instead of 200 grand, I believe it's 300 grand. And then sophisticated would be that you fall below that threshold, but you kind of understand the risks of investing. You maybe have some investing experience, things like that. Yes, we take both. I would say most of our investors are accredited, but there are some that are non-accredited. Yeah, we can only take about, I believe, like 20 or 25 or something like that on each deal that we do, non-accredited investors and only sophisticated. but we were never really close to hitting that threshold. And so, yeah, open to both those.
All right. Well, again, thank you for your time. I know we went a few minutes over, but great information today. I appreciate you sharing that with our audience. And again, if you have any questions for Rohan, Pooja, or Sapin, you can reach out to them at JT Capital. Obviously, they're happy to answer the additional questions that we didn't get to. And certainly on, somebody asked about GP fee structure, which we kind of touched on, co-GP opportunities, the property management teams, et cetera. So just those people that ask those questions, just reach out to one of these individuals to get those answers. But again, thank you very much for coming on. If you have any questions on self-directed IRAs, here's my contact information as well. Thank you all for joining us. Any final words that you all wanted to share?
Just thanks so much for having us. We really appreciate it.
All right, good. Appreciate it. Yeah, we'll have this recording link up on our YouTube page and share with the rest of the audience who couldn't make it, or if you were someone listening live and want to go back and re-listen to portions, we'll have it up there. But thank you again for coming on, and thank you everyone who attended.
Awesome. Thanks.
Thank you, guys. Bye.
Thanks, Scott.
Thanks.